Welcome back. So now we are into the second session of monetary policy transmission, and we are trying to understand that how different instances of monetary policy change with respect to rate of interest, how it impacts the different segments of the economic system, including the market and the external and closed setup economies, the variables that we often use for these economies to understand. So we were in the last session trying to discuss or touch upon the exchange rate channel, and we said that when the rate of interest comes down, domestic asset become less attractive, there will be capital outflow, the currency will depreciate, and this will boost the export, and finally the aggregate output will increase. But is this the a straightforward case in real life? There are certain regions because of which it may not be true, right? So this is what, if the expected as we mentioned the spot rate of the and change in the spot rate, if the expected spot rate is depreciation is more than this, then your currency is going to depreciate further, and if it is equivalent, then it means that investors are getting what they are having the interest rate difference and what the exchange market both are same. So interest rate parity becomes very important, and here I am using uncovered. You can also use covered in the sense that you will be taking the position to cover your exposure. So you may not be needing the exchange rate immediately, or you may not be converting your currency immediately. If you have a settlement date in the future of the expected cash flow that you are going to see, then you can buy the forward and settle the contract on the agreed pre-agreed price of the exchange rate. So this is how it matters. We also touch upon some of the structural setup, which is the Marshall condition based on the elasticity of export and import, and if it is less than 1, then we say that it is not good, which means your depreciation is not passing 100% to the net exports. If it is greater than 1, it means that 1 rupee depreciation, it is like passing on to the net export by 1.23 or 34, right. So this is how we often calculate this. So let's move on to the another example that we are going to discuss. So another example could be in the form of, let's understand this. We have the depreciation, elasticities and quantity I have mentioned. So how currency depreciates? So we are saying that currency depreciates by 88, and suppose we are saying that the elasticity of export is, suppose we are saying that it is the price change is 10%, and the elasticity of export is coming out to be 0.6, then we can simply multiply this price, because formula of this is quantity upon price. So I can just change the we have to solve for quantity, so we get the quantity 106, right. So percentage delta qx upon percentage delta px, right. This is what we get for the elasticity. So we are solving for qx, so this is getting multiplied. So we are solving for delta qx is nothing but here we have multiplied by percentage delta px, right. So this is what here we have. Prices in USD this year we have the 10%, and prices and import elasticity is minus 0.7. So what we also get here is 111.6 if the price goes by 10% up, and import elasticity is again 0.7. So this is how it looks like. So depreciation makes exports cheaper, this is what we are saying, and import costlier, and this is what we are seeing an increase, right. So this is what we are getting in terms of given the elasticities that here we have, right. So this is how we are assuming. Now export value, if you want to calculate that how much is the value, so this we are saying that with the actual original USD INR, so this was the 80 rupees, but then we saw 10% depreciation. So then we saw 10% depreciation, so it became 88. So at 80, here we have the export of 8,000, import of 9,600, and then here we have the export in period 1, it is coming out to be 8395, and import is coming out to be 9820, right. So this is what here we have. Net exports is how much? It is minus 1600 we are seeing, right. But net exports we are seeing minus 1425. Now, you can see that in the beginning we saw that the export was only 8,000, it went up to 8395. Import, it was 9600, it went up by 9820. So, if you see in terms of the moderation, so here we are seeing that the export is slightly getting better, right. It was minus 1600, now it is minus 1400, right. So, it means that the deficit is shrinking, which means that export is doing better, right. So, this is what it implies here. So, I hope this example of in value terms, that how much in terms of not in percentage, but value terms it is helping, this we are seeing it here, right. So, this is what here we have. Now, elasticity check, if you want to see how we are getting. So, this is how we are getting with 100. Here we have the price that we are seeing. So, here we have a price assumed at 100, price is 1 and here it is 100, right, and then we are seeing that there is a decline by a percentage of 10%. So, here we have the 10% decline. So, this we are seeing, right. So, this is what we get here. So, 0.9 minus 1. So, this is what the percentage change in quantity, percentage change in price, and finally, we are getting 0.6. Import demand that you are seeing. So, this you can also calculate in the same way, and then you get 0.6 and it is coming out to be 1.3, which is greater than 1, right. So, this makes the overall when the rate of interest is coming down, it is having impact on the capital outflow. Capital outflow is getting bigger, and as a result your currency is depreciating. This depreciating currency is passing on more benefit to the net exports than the actual depreciation, and this is how it is. So, 10% depreciation improved net export in value term and satisfies the Marshall-Lerner condition that it is supposed to be greater than 1, right. So, this is what it implies. Now, you must be wondering that why are we doing so much of calculations when we are dealing with the commercial banking. So, you can see that commercial banking nowadays post Dodd-Frank Act in the US, majority of the banks were given the opportunity to become investment bank and participate in wide range of asset classes. In the same way, in most of the developing countries too, we find that majority of the commercial banking system is aligned with the forex market. So, they are one of the major buyers and sellers of the foreign currency. So, for example, forex exposure and balance sheet. So, depreciation of INR, right. So, raises the INR value of foreign liabilities. It means that those who have borrowed money, for example, companies, they have gone for borrowing from the foreign locations. If rupee is depreciating, then you know that the cost of borrowing is going to go up, and this will bring further liabilities, right. And also, if the foreigners are saving in Indian bank and they are keeping their money, right. So, deposits are normally liabilities for the banks. So, if they are getting liabilities, and of course, this depreciation will make them will make banks to pay a higher amount, because even if the rate of interest is 6%, rupee has come down. So, they will be converting that at the newer exchange rate, not at 80, but 88 that we saw just now in the example. Then for the bank it is an extra cost, right. Exporters see better cash flows and importers face the margin impression, because we know that you have the, if you are importing, then when you have rupee depreciating, then importers will be paying higher price, right, for most of the goods. So, whatever margin that they had, for example, earlier they were importing at 100 rupees, selling in the domestic market at 120 rupees, but now because of depreciation it has gone up to 114. So, now the spread has come down. So, their profit margin will be also much lower, and if it further reduces, then they will be also wiped out from the market, right. Credit channel import heavy firms, right, crude oil refiners face higher working capital needs, right. When they have the rupee depreciation, then they see higher cost of payment, and as a result they will be also asking for a lot of extra money. And in some cases, when these banks are not able to pay, on time to these banks, then they will be also incurring huge losses in the form of the NPA risk. So, non-performing asset risk also increase. Then here we have the letter of credit kind of business and trade finance. So, letter of credit also becomes a very interesting case. Nirav Modi case we have in India, it started with this kind of setup wherein we provide liquidity to the exporter and importer at the critical time, and when they see depreciation appreciation, then this exposure may further derail the overall smooth functioning of the contract. Liquidity and regulation, this we have added with the RBI setup, especially. So, RBI may intervene via spot and to stabilize the INR, which means that they can, if they see more capital outflow, as a result they will be seeing a dollar depreciating. So, they will be selling the US dollar also immediately to the market, and then they will be trying to rescue the rupee fall immediately. Forex reserves and VRR, the variable reverse repo rate, SSR also interact with the liquidity, and this is how we often find in most of the cases, right. Now, here we have the forex loans also. So, here I have given one example that a bank has extended USD denominated loan to an importer. The loan amount is $20 million. The exchange rate is INR USD this. So, 20 into 80, so it is around 1600 crore rupees, you can see. Now, we after 10% depreciation that we are assuming, it has come down to 88, right. So, now the rupee value has gone up from 80 to 88. Now, you have 20 into 88, now you can see 1760 crore, right. So, 160 crore that you are getting extra cost just because of depreciation. During mid 2000 period, when we saw the rise of twin balance sheet crisis that I discussed also. So, twin balance sheet crisis, it was basically during mid 2000 investment boom that we had seen in India, right. So, what is happening with that? So, mid 2000 investment boom that created, and even the rupee had appreciated at that time against dollar. So, rupee had appreciation. So, many firms went for external borrowing. But then due to 2007-8 global financial crisis and European debt crisis, and European debt crisis, we experienced that the cost of borrowing of these companies went up, and then they were also, it was also one of the factors responsible for their insolvency. So, bankruptcy of majority of the firms, the exchange rate depreciation was also one of the forthcoming reasons that how these companies started getting or becoming worse and worse, and they experience very unprecedented kind of situation. So, liability increases by 160 crore, you can see borrower leverage worsens, and then there is a higher risk of default, right. So, this also becomes really important here. Then Tobin's Q, equity prices and monetary transmission. So, here we have, when we have the rate of interest coming down, the stock price of the stock will go up, the Tobin Q ratio goes up, and Tobin Q ratio is a good indicator for making new investment. So, as a result, investment goes up and aggregate demand goes up. So, this is the new channel that we are examining. So, it is related with the equity price, which means that the finance or you can say wealth effect kind of channel. So, what is the means? So, Tobin Q definition is that it is the ratio of market value of the installed capital upon the replacement cost of capital. So, what is the replacement cost? The market value of the installed capital means that the price of the stock is going up, the overall wealth, the market value of the company goes up, and in that scenario it becomes very easy for the company to replace the existing capital. But if the price of the stock is coming down, which means that the numerator is getting lower, then you know that the lower Q value is not good, higher Q value is good, then you know that you will have to continue with the existing assets and you cannot go for replacement. So this is how we have. So firms can issue equity at high valuations and invest in capital. Policy rate cuts raise equity prices by lowering discount rates. Higher equity valuation push Q above 1 and is stimulating the investment. So this is also one of the reasons that how it helps. So let's have the understanding about this. So let's understand the rate cut and equity valuation. So Gordon formula, which is related with the equity valuation, he suggested that equity price that here we have, the price of the stock, is nothing but the expected dividend upon the K minus G, and K he had mentioned about the required CAPM based kind of return, given the beta and given the market premium, how much you expect the return, right. So CAPM equation, how do we write? So we write here expectation of RI is nothing but RF plus beta time RM minus RF, right. So this we write in terms of expected excess return, that if you want to get, so you can also write RF RI minus RF alpha plus beta RM minus RF, right. So this is what we get, and you can also add absolute term if you want to make it stochastic, right. Till here it is deterministic, you can make it stochastic, right. And here beta is nothing but sigma IM upon sigma square m. So market, how much it is connected with the market. Now you can see that this expectation is also linked to the rate of interest. If the rate of interest is lower, your expectation from the stock is going to be higher. If the rate of interest is higher, your expectation is going to be lower. So it is also linked with that. And G is the growth rate. How much is the dividend growth rate? So if suppose dividend is rupees 10 and growth is 3%, required return fall due to monetary easing. So you can see that if you just substitute this formula, right. So if you have if you just go by getting the formula, so 10 upon so and 10% is also the expected, this is the K, and minus 0.3 is the growth. It is coming out to be price of the old stock price is this. At 8%, if we are saying 10%, so this is what the 10%, at 8% we are seeing that the stock price is going up. What does it mean? It means that if K is higher, right, so you know that the price of a stock is going to be lower, but if G is higher and K is lower, so then we know that the P price of the stock will go up, which means that the growth G matters and K is supposed to be lower, and this is how it also matters in most of the real. So this is one of the important formula to calculate the cost of equity and cost of equity prices, which we often use in the weighted average cost of capital. So this is where it is very, very important, right. So this is what we get. So assume that a firm has 10 shares outstanding. So what do you get? So at this price you will be getting 1428, and at this price of the stock that we got we will be getting 2000, right. So replacement cost of capital is suppose 1000. So we know that the Q value is coming out to be 1.43 and here it is 2. The Q new is better than the Q old because the interest rate decrease has certainly appreciated the price of the stock. As a result, the Tobin Q ratio has gone up. So this is what it implies. Investment response to Q. Let's have the understanding about the investment. So this is related with the growth kind of setup. So here we have investment, it is linked to the depreciation into the capital that here we have, plus 5 we have the speed of adjustment, right, motion that you can see, and here we have the Q is the Tobin Q ratio, and minus 1 we are assuming, and then we are saying that it is the capital, which means that if we have the delta depreciation portion going up, then it will have a lot of impact on the capital. And similarly, if the Q is almost equal to 1, so this whole equation becomes 1, and you are just having what you have, the investment is equal to what is depreciation and capital. But if Q is greater than 1.3 on all, then this will be added to this particular value. So, overall your investment will shoot up if the Q is greater than 1, but if it is Q less than 1, this will be subtracted, because this will be minus, right. So, this will be subtracted from the investment, right. So, this it means that you will have to shelve some amount because of the replacement cost of capital, right. So, this is what we get. Suppose we are assuming that K is 1000, del is equal to 5% and phi is 0.5, and Q value we have already got 1.43 and 2. If we are substituting these values here, what we get is the investment before easing, it is coming out to be 265. After easing, it is coming out to be 550, which is much better, right. So, because of this interest rate change, given the capital depreciation and also the adjustment speed, we are seeing that we have added 285 total investment, which is a good thing for the economy, and this is how you can see the Tobin Q ratio becomes really important when we try and understand the investment in the economy, right. But the brighter side is that it helps you understand the investment, it helps you understand the valuation of the stock price, because this is also one of good measures, but it also certainly lacks on some front. For example, equity mispricing or bubble. So, what happens if the price of the stock is just sinking with the market, it is overvalued, right, but it is sinking with the market, which is security market line that we have for the CIPM, it is below that, but it is what is the case that it is sinking well with the market. As a result, the market value is going up, right, and then we are seeing this Q value increasing, but it may not be the same, right, but not fundamental. This is what implies that it is overvalued. Financing frictions, bank may restrict credit despite high Q, which means that you have gone for aggressive investment. For example, certain companies in India, because of their political lineage, they know that they will be getting all those contracts. So, even though they go to the bank and ask money, the banks often decline, right. Slow adjustment, which means that if you have a capacity related issue, then this will further create trouble. Sectoral coverage, non-listed firms may account for large investment shares. Debt overhang, which means that you will not, companies sometime are not allowed to borrow beyond certain levels. So, for example, given their asset size, given their collateral strength, suppose the value of the collateral is 500 crore, then the banks will not finance so they will say to the firm that you cannot go for borrowing from us more than 500 crore, because this is your debt overhang, you have touched your maximum limit. Until unless you pay back some amount, create a space for you, then only you will be getting, otherwise you will not. So, these are the issues that we often get with the situation. Then there is something called cost of capital, which is related with the weighted average cost of capital. Weighted average cost of capital is simply the cost of equity plus cost of the so here we have the cost of equity, then here we have the cost of debt and preferred stock, you can say. So, this is what is the KP is the preferred stock. Given the K is equal to 12%, KP 10%, KD 8% and total cost 30%, we see that weighted average cost of capital, if we substitute these values. So, this is the amount that you want to borrow, for example 6 to 8 and 10. So, total amount of capital required is 1000 crore, and you are dividing that into 3 assets that you want to borrow through bonds 200 crore, through preferred stock 200 crore and through equity you have 600 crore. So, this you can see that your weighted cost of capital, weighted average cost of capital is 10.3%, which means that a rate cut reduces the debt, right, and K, and overall we can see that it is lowering the WACC, and this is also linked with somewhere the bond issue and also the cost of equity, and cost of equity is again linked. So, when Q is greater than 1 and R decreases, product with IRR is greater than WACC, and this makes the investment attractive. So, when we have this situation, so IRR greater than WACC, then this makes the overall situation attractive. So here we have how banks enter the Q channel. So collateral valuations, higher equity prices raise firms' net worth, and collateral equity, easier access to bank credit. Then here the lower borrowing cost, a policy rate cut reduces a bank's funding cost and lower the lending rates for the corporate clients. Credit supply response, again this is also one of the important. Banks often need working capital loans, term loans, project. So whole lot of things you can see. Higher Q also strengthens the balance sheet because this will further expand the overall valuation of the company goes up. So numerator is going up. So this creates the favorable outcome and less default, right. Government and PSB are often linked here, as I mentioned, for the twin balance sheet. So overall, when rate of interest comes down, price of the stock goes up, overall Tobin Q ratio goes up, overall investment goes up because of these channels that we are discussing, and your aggregate output goes up, right. So this is how in most of the real life situations we discuss. What is more interesting to understand is that when we are finding these channels, we are also understanding that these channels are equally useful. For example, I have given you one example here, that suppose a large Indian firm in capital goods sector is valued at 20,000 crore, replacement cost of capital estimated as 14,000 crore. So Q is coming out to be, so here you have the 1.43, right. The monetary easing leads to lower policy rates, the market cap rises, suppose it is. So when we know that rate of interest is going, so price of stock is going up 22,000 crores. So now Q is 1.86. Now higher market cap boost collateral value and the financial ratios, right, and they will be also. So probability default we will be discussing, we will be discussing the Basel II norms, and finally we can see that since the valuation has gone up, so they will be again giving 2,500 crore rupees extra to expand the business, and this is what it overall looks like in most of the situations, right. So what is the likely scenario, that when the Q ratio is higher, when market value is going up, so your collateral value is going up, and as a result you can ask for more borrowing from the banks, and this is what it implies here. So with this, I hope you are able to understand the investment channel of the monetary policy transmission and how it impacts and how it deals. So with this, I am stopping it here. Thank you so much. I hope you are enjoying the course. Thanks a lot.